My name is Haley Margetta. Thank you for the intro, Shannon. And for the next 45 minutes, I'm going to be your conductor through the numbers. Joining me on stage are our fantastic panelists. I'm going to give a short intro for each, and then we're going to dig in. So to my left, your right, is Darren Cotter. And Darren Cotter started a company in his dorm room in 2000. And it was a tech company. And over the next 25 years, he grew that. He bootstrapped it. And I think at 25 million you grew it to, and then you exited in 2021, which is really impressive. At the same time, he got into angel investing as a hobby in 2013, and I believe now he does that full-time as of 2021. Darren has a portfolio right now of about 100 companies. They are mostly in the B2B, that's SaaS, marketplace, consumer tech space. Most of them are Midwest space as well. Well, that's Darren. We also have Kelly Perkle, who is the founder and managing director of Engage Venture Partners. So Kelly's got over 20 years of experience as an executive across the healthcare continuum. So as a founder of Engage Venture Partners, Kelly works with a network of accredited investors to invest in early-stage med tech companies. Kelly and her partners research, source, and support Engage's growing portfolio of med tech innovators in Minnesota and beyond. Last but certainly not least, Mr. Reed Robinson. Reed is a founder, he's a community builder, and he's an investor. His direct startup experience ranges from co-founding a small consumer tech company all the way to an acquisition as an employee of a venture-backed startup. Many of you probably know Reed because he's a co-founder of Beta as well as Twin Cities Startup Week. Reed has developed programming and channeled community investments into Minnesota's most promising early-stage startups. With Groove Capital, Reed provides first check investments to our area's top innovators whose products and services make the world a better place starting in Minnesota. So that's a pretty kick-ass panel. Can I say ass? Sorry, I don't know. I mean, I'm the pinch hitter, so I'm a total wild card. I also brought note cards because I wanted to feel like I was on a talk show. There's really nothing on them. I'm using my iPad. So with that, we have a bunch of questions about numbers, and it's fantastic. I'm a newer angel investor myself, and so the first question I'd like to ask each of you is about your investment thesis, or otherwise your investment focus. What are you looking at when you're making an investment? And you're on my left, so do you want to start, Darren?
Happy to start.
Good.
So quick experience on me first. I've been investing in this asset class for a decade. For 7 years as what I call a personal hobby while I was running my company, built a portfolio of a few dozen companies over that time, and now since selling my company a few years ago, I've been doing this full time and loving it every day. So that's my experience. That gives you some context on if you should listen to anything I have to say or not. I will also add that I'm pretty sure I've made every single possible mistake you can make as an angel investor. So if you can learn from those mistakes that I made and save some money yourself, definitely worth the price of an Angel Fest ticket. This year and future years as well. In terms of thesis, I'm typically mostly investing in digital companies. So sorry to CPG founders like Angie, who built an awesome business. She specifically called this topic out. I'm specifically investing in software and digital companies, not so much physical products. I'm typically investing at the seed stage. To me, that means you fully launched the product, you have some customers, you have some revenue. Occasionally, I'm investing at the pre-seed stage, but not quite as often. And then I'll call out one other thing, because I think we're going to talk about it later on the panel, which is my thesis. I subscribe to the power law thesis of angel and venture investing, which means the overwhelming majority of your returns as an investor are going to come from a very small number of investments. So for me, my criteria when I'm looking at a company is something along the lines of, if everything goes right in this company, no, it usually doesn't, right? But if everything goes right, can this company produce a 50x or a 100x return? And the inverse of that is there's lots of companies and founders I see that I like a lot, but the ceiling on the company is probably something more like 5 or 10x, and I pass on those investment opportunities despite it, otherwise being a great company. Now, I'll also add, that's not the only way to angel invest. One thing I love about this is it's a game with many ways to play and many ways to win, so that just happens to be my personal thesis. There's lots of other ways to angel invest, and they're all great as well.
Awesome. Kelly.
Great, thanks. So I'm super excited to be here representing Engage Venture Partners. We are 4 partners who came together with medtech and healthcare experience. We're operators, we're founders and executives ourselves. And we know and understand that there's a ton of incredible investment opportunities in that early stage medtech space, but it's incredibly challenging to research and diligence on your own. And so that's really the foundation of Engage. We do the hard work digging in. We leverage our experience, our networks, and our core knowledge in these spaces. And we bring hand-selected investment opportunities to our investor network, share our diligence, and allow our investors to opt in or opt out of each deal as they see fit. So really trying to reduce barriers to entry and really focused on leveraging our knowledge and expertise in order to improve access to deals and improve capital in the ecosystem.
I'm Reed Robinson. I'm the founding partner of Groove Capital. In the introduction, it was kind of laid out, we're looking for incredible companies that can positively change the world starting in Minnesota. We are just on the edge of finishing our first fund and kind of looking back over the last couple years, launched in early 2021. We've invested in 56 companies with 90% of our capital going to teams based in Minnesota. So we have a very much geographic focus. We invest in a high volume in a variety of categories, but all of them have to have some kind of reference point to them making sense to exist here. So geographically, that's been where we've been at. As far as what we look for, we want to invest in great teams with great leaders who are chasing enormous market opportunities with some evidence or history of demonstrating that they have a skill or unique kind of competitive advantage to do exactly that, to capture that market opportunity. So that's what we've been doing for the last few years. It's been a blast. Michaela, my partner, is now joining us in Fund 2, which is really exciting. We're just getting that started, where we'll be switching from a $100,000 investment as our kind of primary investment to more like $200,000, $250,000 as where we get engaged in the companies that we're supporting.
Thanks, Reed. The cool thing about this group is you're going to get a variety of perspectives. You have the fund side, you have company perspective, and then you have the individual investor. So wherever you're at in your journey, you're hearing the different thoughts and processes of these folks. So I have a lot of questions on my blank note cards, just kidding. But I want to play a game. So the lightning round, which I'm hoping many of you are familiar, where I'm going to rapid fire questions at these guys. You're not supposed to think about it. You write your answer down, and then you'll show the group. Okay? The investor is ready. Okay.
We are prepared.
Here's the first question. On average, how many days does it take you to get to a yes in an investment? I need the Price is Right music. Ooh. Now, I know I said rapid fire, but like there's kind of a difference here. So we have 20, 30, and 90. Does someone want to speak to why is engaged longer than, let's say, a Groove or on the individual side?
Sure, absolutely. So because we're digging in really deep to these very complex areas of risk in early stage med tech, it takes a while. We're looking at the IP portfolio and how broad that is. We're digging into the technical aspects of the actual, if it's a med device, of the actual device. We're calling, if there are customers, we're calling customers. We're digging in to the regulatory pathway, so the pathway to FDA approval. All of these things are very complex in order to understand, and it takes a little bit of time for us to work through all of those in terms of finding those needles in the haystack that we are actually interested in investing in.
Thank you. Makes sense. All right, next question. What is the average number of companies you screen before you get to a yes? Silence is killing me. Leave it to the individual. He's writing us a short book. Well, okay.
It's a funnel. It's
okay,
a funnel.
that's good. Show it. Okay.
It's too small, Darren.
Review. What do we got? Review, meet, and invest. So we get all the way to 1. Okay. All right. Here's our next question. What is the average valuation of an investment that you're considering? What is the average valuation of an investment you're considering?
I'm slow.
Okay. And again, you can go ahead, Reed.
I'm the lowest, which makes a lot of sense based on,
Yeah.
I've co-invested with both of our panelists. And usually what happens in most cases, in both groups is we even set our thesis up to be the first institutional investor leading the pre-seed round. That's where we do our best work. And pre-seed it can be also called an angel round. It's adjacent to friends and family. It has a whole bunch of different names. It doesn't really matter. We're the first institutional check. Therefore, we desire to go one stage earlier than most to identify and lift up the entrepreneurs that we think have the ability to get to that next step. So our job in that, when we're investing at the lower valuations, is, hey, the markups are better, but let's graduate them to other investors in the network who are waiting for a little bit more evidence, a little bit more trending data before they're ready and prepared to make the investment. So that's why we exist, which is why we're lower.
Are you ready? Next one. What percentage of your portfolio companies do you expect to fail? These are really good. Darren, you guys see that? 80%, 0, and 70%. It's like, someone's got to talk about that.
Well, I will say our model's a little bit different. And when we say expect to fail, so Engage is not moving forward. We have an SPV model, essentially mini funds of one for investors to opt in and opt out of. We're not moving forward with an investment unless all 4 partners are investing our own capital. And so from a selectivity standpoint, we're fully aligned with our investor base. And so if you say expect to fail, we are not making that investment if we have that expectation. Now, we're not naive. We understand the laws of large numbers and statistics, but being a relatively young company, we've got 5 investments so far, and we feel really great about all 5 of them, and expect to fail, we don't.
I see what you did there. That was clever.
Yeah, so did I.
Just speaking very
They're real
quickly.
professional.
Yeah, I'd like to change my answer.
Okay.
To venture math, if you just startups are really freaking hard, and that's something that's really important to understand as an investor. You should go into this asset class fully expecting that whether it's 70 or 80 or possibly even 90%, the majority of your investments will fail and return 0, and you need to build that into your thesis.
Our next question. It's a good one. What is the minimum check that you write? Okay, so we got Reed's over the 200K at a 7.5, and then I don't know if the guys over here can see it, but 5K at Engage, and then Darren's got, what do you got, Darren?
20 to 50.
25 to 50. So again, it's quite a span, and it would be helpful if someone would differentiate the check sizes and why they're different for the
Yeah,
group.
so at Engage, our angels or investors can write $5,000 checks for most of our deals, and that's how we bring together a group in order to put together the special purpose vehicle and invest as one line item on the cap table of the companies that we're investing in. Our average is about $800,000 in terms of our average check that we write with that group all coming together.
It's the same for us as far as the number at the top is what we invest from the fund, what we allow our LPs and our angels to co-invest alongside our deals. I would say the average for most of those co-investments is somewhere around $7,500.
Let me just add an angel perspective here too. I personally invest generally 50K in companies, but that doesn't mean you have to invest that much as an angel. In fact, one of the things I just took away from Angie's story, which was amazing, is that early on in their trajectory, $10,000 changed the scope and trajectory of their business, and look what they became. So it doesn't have to be a big number. You can help in ways other than capital, but a $2,000 or a $5,000 check can be super meaningful to companies.
That is a myth, and I felt it joining an angel group where, well, I don't have $100,000, and it's just not true. And oftentimes, if you have a specialty, if you're a CPA or an attorney, or there's something you can really add to your company, you can always talk with the founders as well. How does your background and experience add to the money, the checks that you can contribute? Okay, a couple more questions here. The next one is, what is the average round size that you see when you're making an investment? $1.5 to $2, $5 to $7, and $750. And I think that makes a lot of sense with the ecosystem here.
Again, the stages of
Yep.
investment for each of us, that makes sense.
2 more to go. How much equity on average are you taking? $2 to 5%, 1 to 10%, and 50K.
50,000 divided by 2 million.
Yeah. Love this.
Which is another way of saying I'm not ownership sensitive here. I'm not a fund, so I don't care about ownership percentage or whatever the valuation is. I'm getting my investment divided by that.
They didn't warn me about you, but they should have. Oh, just kidding. All right, here's the last one. I want to know, when you make these investments, how many boards do you sit on? Zero. 1, 5, and 0. Read. Okay. That surprised me. I just thought, again, not knowing anything, oh, I'm an angel, I must get to have access to the board or be on the board. Can someone comment on that? That's just not reality?
Our volume of investing makes it impossible for us to do that. We just don't have the time. And the stage that we're investing at, they don't have boards. Like our goal is like, hey, you should think about a board sometime when we're working with them as portfolio companies. You're getting close to that seed stage. Now it's time for you to maybe formalize some of those relationships that have been informal advisors into formal board advisors.
Good. All right, that's the end of the lightning round. One other thing we could take away from this is more business meetings should be run as lightning rounds. We would get like a lot more information a lot
Very
quickly.
efficient, yeah. I love it.
Just saying. So let's get back into the questions. One of them that's very relevant right now is how do we think about market trends and where they interplay with investing? So right now, I think there might be a looming recession. Is that something that should make an angel nervous, or something where an investor could say this would present real opportunities? I'm curious to hear from
I've been
anyone.
fielding this one a lot lately. You guys mind if I start?
Go for it.
Add if I miss any pieces that you'd like to. We've been in an investing recession since the last summer, so it doesn't matter what it's called in the broader market, but it's really hard to raise capital right now for a lot of different reasons, and we don't have time to cover all of it, but later today, what I want you to be thinking about when you're in the line, in the buffet, waiting for your lunch, I want you to imagine, okay, the chicken's at the end of the line, you're number 50 in the line, and the chicken just ran out. You gotta wait until they replace it, and then everybody in front of you has to be served before you get served. That's what's happening in venture right now, where at the end of the line, which is IPOs, acquisitions, there's so much volatility that's happening right now that everybody is scared and they've stopped. They don't want to mark themselves down. They're trying to survive. They're not going to get the return that they thought they were based on what they had marked up from a couple years ago. So everybody is just frozen. And what that does is it impacts every stage before it. So the Series B can't go to Series C, the Series A can't go to B, et cetera, down the line all the way to pre-seed. So you take that situation, which is frozen, and then you mix in a bunch of other potential black swan events and other things, and you basically have a lot of people that are looking for other safer places to put their money. That's all the bad news. The good news is when there isn't mass hysteria around investing, jacking up all of the markups, hey, it turns out you can get a really, really good deal if you are in the game at the right time and have the patience to wait out whatever situation that we're in. And so the conversation that I'm having related to Fund 2 is, I don't know if we're going to have a better vintage than this, because if we're in the game and we're making investments and we're waiting 5, 7, 8, 9 years for these companies to actually materialize, as long as the investments that we're making are in teams that know how to manage their capital well and can survive the current landscape, we're going to be in a really, really good spot. So it's a tale of two worlds. Black and white. What did I miss?
I mean, I'll just give kind of an example. We're seeing some, flat valuation rounds or bridge rounds that were kind of unexpected. The company was going to raise a larger institutional round and is actually coming back for a smaller bridge right now. And they're doing that because they're being smart, getting capital as they need it, and waiting, not taking a lower valuation for a larger round. I will caution everyone, you need to understand what's driving those flat valuations or those bridge rounds. And so digging in and looking at understanding, is this a market opportunity? Is this a team that's making great progress, continues to do great things with the funds that they have? And it's just a matter of headwinds in the market today. That can be a really great opportunity. So just really digging in, looking to understand why the valuation is flat, making sure that there aren't any red flags, but huge opportunities right now for sure.
There's so much nuance that's missed in the headlines, and which is why I love this question and talking about this stuff. But the last piece that I'll add in contextualizing to this audience is, hey, guess what? Like, we've never had a lot of venture available in Minnesota. Our startups have lived through the desert forever. So if you want to invest in people who are good at managing and lasting where conditions are hard, you're in the right place to do that. And the valuations have always been good, and they're getting better.
I'll add quickly, I agree with the headline statement, which is that, for people in this room, now is a great time to deploy capital in this asset class. I think data over the last 40 years proves that out. That data is available if you're interested in researching it. The sub-headline that I would add, and a change to my process now relative to prior years, is I'm paying more attention to the capital efficiency of the business and the business model. Maybe didn't care about that quite as much in the last few years because there's going to be investors to fund the next round, and so capital efficiency was not quite as important. I'm paying a lot more attention to that now. Companies raising $1.5 million, great, but I want to understand, are they efficient? Will they make it to the next round? Maybe that's cash flow positive, so they don't have to raise another round. If not, are they going to hit the milestones they need to hit to raise the next round? I'm paying a lot more attention to that now than I did in the last few years.
That's a good segue, because when you are choosing to make an investment, as the investor, can you talk about if you're setting the terms? And I think the lens on that is, where have you seen it go wrong, essentially, right? Maybe
I'm just a lowly angel, so no, I'm not setting terms, asterisk.
But people might think that,
I agree. I'm rolling my eyes a little bit at situations I've encountered, not you. So no, I don't set terms. However, I'd like to think I can be influential in helping guide founders who maybe don't have the right perspective. And my eye roll is I've seen lots of situations where inexperienced investors have set terms by throwing a number out that maybe the founder led with or they agreed, and that is not a realistic number to raise the rest of the round. So companies that otherwise were going to be able to raise money now are kind of blocked because they have one or a couple of investors at a price that's much too high, and closing the rest of the round is going to be very difficult. And so that's where funds can be really helpful, lead investor, or at least experienced investors working in conjunction with the founders to find fair terms is really important, because if you don't do that, you can kind of stumble and shoot yourself in the foot, not be able to raise the rest of the round, and that doesn't serve anybody.
Yeah, Engage is being asked to lead more often as we continue to put out SPVs and meet with more companies. And I would say that's one of the benefits to being able to come together as essentially a syndicate, that we can work on behalf of our investors to help do those evaluations and set terms that we believe are beneficial to the investment. And frankly, even when we're not leading and we're following on, we're still looking deep into what's behind that valuation in order to make a determination if the investment makes sense.
I think it's important to recognize as an angel, an early stage investor, your job is to be a steward in one link in a long chain of the entrepreneur's journey. And if you try to get too creative on the terms at the wrong stage, you think you might be getting yourself something, but what you're really doing is you're creating a trap for yourself, the angel, and now the entrepreneur that might get in the way of their future success. This was early 2021, early in our investing life cycle. I remember we were looking at a deal, and they were young entrepreneurs. They found this investor on LinkedIn. The investor wrote a $50,000 check. We were looking at the terms and we were excited about the deal, loved the energy, interesting product, etc. This investor had written into the terms that any additional follow-on capital wouldn't dilute him. Everybody else would be diluted except this gentleman. And he had veto power over any potential acquisition. And we just looked at him like, this is dead. There's no one, anybody would ever invest in this after this individual. So this person thought they were getting themselves a sweet deal. He was killing the deal, and he was killing this company. So don't do that. Be good stewards of this. Your job is to graduate these people to the next level. And if you get in the way of that, you're hurting them and yourself.
A good follow-on to that is then when you're looking at an investment and you're reviewing the cap table, when you look at that, is there anything that stands out as something an investor should be concerned about?
If the founder doesn't own enough of the company, probably not the case at pre-seed stage. I see it occasionally at the seed stage if they've raised multiple rounds of financing already. By the Series A stage, post-Series A, the founder should still own around 50% of the company. So if they're at 50% or below and raising a seed round, that company's probably not going to be fundable in the next round. And so I pay attention to that, right? Because if they can't access future funding, that hurts my investment. Another thing that is pretty common now is founders raise a lot on convertible securities. Convertible notes or safes, and it has become pretty easy and fashionable to raise multiple rounds of convertible securities. That's dangerous. There is a relationship between the amount of money you raise on a convertible security and the size of your next equity round, where those convertible securities will convert into equity, and that ratio has to hold true. The more money you raise on convertible securities, the larger your equity round, your next equity round needs to be. The larger that round is, the more traction you need to have as a company to justify raising that amount of money. If you raise too many rounds on convertible notes, again, you find yourself in a situation where the company is otherwise doing well, but not fundable in the next round. I think that's a mistake a lot of founders are making right now, and I've passed on a lot of companies where I love the idea, I love the category, the potential, love the founder, but the cap table is broken because they have 3, 4, 5 rounds of convertible securities and the company isn't fundable.
I have a hard time making a suggestion of spending either too much time or not enough time looking at the other investors in the company. I absolutely would suggest asking the question, who else is involved in this and how did they get involved? Just because there's actually like an interesting story that you see play out on the cap table. Like, who is this person? How did you meet them? I see that there was an employee here that's got a large percentage of the business that's not here anymore. Like, what happened there? So you can actually learn some very interesting things looking at the way that's organized. So look at it, but at the same time, like, you probably don't need to know everything about everyone. And if you see it, there's a variety of the ways that it can look. And I don't think there's any sort of specific pattern matching outside of founders don't have enough equity or there's a bunch of dead weight on the equity table that you should be worried about.
Can we go back to something that Darren was talking about, which is safe, simple agreements for future equity and the convertible debt side? There would be a lot to unpack there. It could be like its own panel, but in the next 5 minutes, I want to know, I want you to talk about valuation and valuation cap, and Kelly, you as well, because I think that's important for the audience to understand the difference and the nuance there.
Go ahead. No, go ahead.
So I won't answer the question convertible note versus safe. I think that topic, there's a lot of literature about that. You can read about that if you'd like. I think they have their own individual use cases. They're very similar instruments with some important differences, and both are fine. The question I will talk about is valuation cap versus valuation, and is valuation cap important? How do you set it? When a company raises an equity round, an investor is buying equity in the company. It's called a priced round. When they're raising a convertible security, a convertible note or a safe, you as the investor are not getting equity in the company today. You're not buying equity. You're converting into equity upon the next capital raise. So that's the difference. There's no valuation of the company in a convertible note because no valuation has been established. So I think some investors and founders misinterpret that as thinking the valuation cap is not important, and that couldn't be further from the truth. The valuation cap is the variable in a convertible security that dictates how much equity you're going to get in the future based on what that cap is. So it's a proxy for valuation, and I think we got the 1 minute here. I would just summarize by saying it's an extremely important variable. You as the investor should be able to see a clear path between that valuation cap, what kind of milestones the company are going to accomplish with the capital they've raised, and what the valuation of the next round is going to be. And there has to be a relationship between those numbers that makes sense. And oftentimes the relationship does not make sense. And so my advice to you as an investor would be, in those situations, if the valuation cap is too high, just wait for the next round of investment. You know, if the valuation cap is 10 million and they're going to raise their next round at 10 million, the 20% discount you're getting is not commensurate reward for the risk that you're taking. You're better off waiting for the next round. So we don't want to see that. We want to fund these companies, right? And so the founder needs to understand that if the next round's at 10 million, the valuation cap in this round needs to be at 5 or 6 million for this to be a good deal for the investor in this round.
When explained, sorry to jump in here, but when explained to the entrepreneur about that dynamic, usually there's an aha like, oh, okay, yeah, now I understand why it needs to be lower to provide you with the incentive to participate now, because they don't want to scare all of their angel investors to wait until the next one because they might never get there. So I've found that if you explain that with the entrepreneur of why that has to be in place, they usually will react and understand that they should be rewarding you for the risk that they're taking now.
Sometimes.
Oh boy, I'm gonna have to stop in. I can't let you two just. Reed and Kelly and Darren, thank you for your expertise. We appreciate it. And an audience, there's a bunch of questions that are way harder that I didn't get to. So if anyone wants to grill them over lunch, just come to me and I'll hook you up. So thank you, panelists. Appreciate you.